For those of you who I haven't had a chance to meet, I'm Joe Seetoo. I'm one of the partners at Morton Wealth. Gosh, I can't believe it's been 40 years that the firm has been around. I'm blessed to have been with the firm for the last 16 years. So I'm here with Cory Johnson of Pender. When you think about what we've heard over the last 18 months or so, right? Rising interest rates, we got a banking crisis we just went through. Commercial real estate is a ticking time bomb waiting to explode. Well, these are all the headlines we're reading, and I think a lot of that is very true. But there's a little more to the story, right? We're a society of sound bites, tweets, where our attention span is about 0.4 of a second. And if we just fall into the trap where we just take the information at face value, I think we have to decipher that this is not actionable advice, and it's certainly not wisdom. And how many times have we heard that alternative investments are risky, that they're only for the ultra-wealthy, that their minimums are too high, that they're not accessible? The pain this causes the average investor is that they may be led astray, they may just be willing to accept an inferior outcome, and they're missing out on groups like Pender. And so at Morton, as you know, we are passionate about democratizing investments so that we can all have the benefit of more resilient portfolios so that we don't suffer from the downturn like we saw in 2022. So with that, Cory, let's go ahead and start off with a little bit of a high-level overview of the strategy.
Hi, everyone. I am Cory Johnson. I am the co-founder and CEO of Pender Capital. Just want to first thank Morton and the team for having us here today and the long-standing relationship that we've had over the years. Pender Capital, we are a commercial real estate debt lender primarily focused on the lower middle market in secondary and tertiary markets across the country. So what does that really mean? We really like focusing on loans that are generally between the $10 to $30 million range. Really, if you make a smile from the kind of the bottom of the country up, that's really more of our focus. We like a lot of the communities in neighborhood or in markets in Middle America, flyover. We don't do a lot of business in the Northeast. Although I am based in California, we do not do a lot of business in California. So I think probably a little different than some of the other exposure that you may have. We really like some of the business in other parts of the country. Our headquarters, we actually moved it about 2 years ago to Dallas, where we've had an office there for the last 7 years. And really excited, again, to be here today.
So we hear this notion that the real estate market, the lending market, is truly compelling. And can you expand on what does that specifically mean in the deals that you're seeing and why we're excited about the opportunity, despite the fact, again, the economy's on the verge of a recession, rates are dramatically higher than they were over the last 18 months. There's a lot of concern about the commercial real estate environment.
Yeah, I think, well, first you got to take a look backwards. Where things were at, even in the pre-COVID world. We're a group that used to be rather agnostic to what type of commercial real estate asset we were lending on. Whether it's multifamily, was all the way down to hospitality and retail. That's a lot of business that we've done. We have always, from our initial kind of outset, our thesis has always been principal preservation first, yield generation second. And I think as we moved along and we got into COVID, we really had a situation that was battle tested. We had a lot of exposure on the side of the barbell that did not recover very well, being retail, office, hospitality, healthcare. As we worked through those assets and never took any principal losses, I think that was very much proved. And I think as we came back out of that on the other side, really, what were we comfortable lending on? We are one of the groups, our thesis, the way we look at assets, we're always underwriting to a refinance. And I think that is a little different than kind of the other groups that we've come across, whether they're the mega players or whether they're down to the small regional guys. What that means is we're making a 1 to 3 year bridge loan to a group that's, say, buying a 300 unit apartment building, doing some value add to it, and then ultimately refinancing it down the road. We don't underwrite to a sale. And I think that is something that makes us rather unique. And so when we looked back and we started originating again in 2021, well, what assets did we really feel comfortable with? Multifamily, we still have Fannie, we have Freddie, we have HUD still lending. Industrials performed very well, storage has performed well. So as we kind of moved back out in early 2021 and started originating, significant, amount of business again, we were really focused on those areas of the market. And where we really kind of come through today is, we saw what happened in 2022 with interest rates and then, the banking dislocation earlier this year. It's really just led us to be hyper-focused on certain segments of the market. And ultimately, as a lot of our loans are now starting to roll off from 2021, this is where other lenders are having some challenges getting paid off. Being able to reset their real estate exposure with new valuations, because the valuations today are not what the valuations were in 2021. And you're seeing that all over the news.
Sure. So maybe talk a little bit about the quality of the borrowers, the deal structure, what that looks like. Because certainly there's, I think, from the average investor's perspective, it's like very concerning.
Yeah, I mean, you look at every headline, commercial real estate is going to fall apart. Everything is getting taken down. Now, when you really kind of peel back that onion, so to speak, without a doubt, the office sector is massively challenged. Healthcare, massively challenged. Segments of retail starting to recover a little bit. Leisure hospitality is looking a little bit better in our eyes, but again, there's not any liquidity for that kind of on the back end. With the regional banks dislocation, that was always regional banks represent the vast majority of kind of the lower end assets of what they're holding on their balance sheets. What we're seeing now is these banks are all but seized up. So on one hand, that does create a bit of concern and a significant amount of concerns. You have a lot of real estate debt that it will be rolling off over the next 3 years. But on the other hand, what it's done is it's all of a sudden opened everyone's eyes to where is the opportunity set going to be. I was on a panel 3 weeks ago. The CIO of CalPERS was on right before me, talking about where's the most interesting opportunities right now that we're seeing in real estate. Private credit, because we don't have any liquidity from the banking sectors. So you're seeing this kind of push into where these opportunity sets lie. Now, when you've got some really good real estate sponsors on the other side, which you're going to hear from a few of them later today, a lot of these groups have a lot of dry powder. They're out actively negotiating deals, actively negotiating discounts in the space. Where it's getting really compelling for us is so much of that really high tier quality business would generally fall off to a bank. We're going to compete with banks for bridge loans. They're all but gone. I mean, we've got a banking relationship in Texas that they said, we're not going to do a one-off CRE loan until likely the end of 2024. Wow, okay, so you're not doing anything. You're already seeing a larger inflow into the private debt providers. Again, we're staying more focused on multifamily for the time being because we still have a takeout market for that. But really, the nice thing, the borrowers, and I'll just use some, anecdotal numbers. Borrower negotiating a deal on, say, a $50 million, 2021 valuation. They're picking it up right now, and I'm talking about multifamily, which is still the darling, picking it up somewhere in the, $38 to $40 million range. Now they're coming back over to us on the debt side, and instead of asking for like a 70% loan to value, or in some cases a 75% loan to value, they're asking for a 55% loan to value off their new valuation. So what it's really done for us is we're seeing the highest quality sponsor borrower on one side of the table asking for less leverage on new valuations, understanding that they're going to be paying more. So when you really kind of pull this all back, I believe we've got the highest, best rated risk-adjusted returns that we've ever seen.
So just to recap, you're saying essentially better borrowers, paying more at a lower loan to value, so you're in a better position protecting us in terms of our capital, and they're paying at a higher rate.
That is absolutely what I'm saying.
Love that.
And it's not just, when you have billionaire family offices that are coming to a private debt provider asking to potentially provide them debt, that just has historically never happened. So there is a huge opportunity set that is building here. And while transactional volume is very, very slow right now, this is why we love being on the debt side currently, because we're dealing with primarily small equity funds, large equity funds, large single-family offices that have a real estate division, and they are all out there actively renegotiating deals. Hey, I was going to pay this, I'm not going to pay this anymore, I'm going to pay this minus 20%, and then coming over to us. So we're seeing this massive amount of business that's coming across our desk that, candidly, it's exciting for us on one end. Now, on the flip side to that, you are seeing other groups, and I have some serious concerns with the CLO market, collateralized loan obligation market, that you have a lot of lenders that more or less look like us on the surface, but they are highly levered internally. So if they say have this $100 million fund, they may be lending out $400 million plus worth of loans. So any dislocation in that market could have some very negative impacts, and that could happen very quickly. And
just to be clear, because they borrowed $300 million from a bank, from other sources, they're paying leverage on that, but thinking they can lend it out at a higher rate and make the spread.
When the markets are good, they make more money, their returns are higher. But when any dislocation happens, which we're seeing right this moment, these groups are effectively underwater on their loans where we stand today. So you're seeing this going back to, we've always taken a very conservative approach. The loans I was talking about we wrote in 2021, a lot of those assets are worth significantly less today than they were in 2021. But it's been very nice, and I think it goes back to the way we very conservatively underwrite these deals going in, that our borrowers have been able to refinance, not just sell, refinance out without having to bring additional equity into the table. So more or less what I'm trying to say is I think we did a very good job beating up our borrowers on the way in, but what it allowed them to get out, on the flip side without having to bring much else to the table.
I want to pivot the conversation because we're moving things along pretty quickly. You went through a huge conversion from a private fund to a publicly registered entity through the year. You say there's a ton of brain damage, but I think the audience really want to spend a few minutes digging into what that was like, what the benefits are for investors, and what the benefits are for Pender also on a go forward.
Absolutely. When I heard Megan and Jeff talking about some of the very exciting things they have on the horizon, it just kind of brought me back to
PTSD.
Oh my goodness, many more gray hairs that were on the head post-COVID and dealing with the SEC for about 2 years to get that all the way through. Yeah. So ultimately, we decided, and we started this process back in middle of 2022. Or I take that back, middle of 2021. Blocked it all out. Of really understanding who our clients are and what our type of alternative product can do for their portfolio. And we've had the luxury of working alongside groups like Morton through the years. Have done an extraordinary job of finding managers and really matching it up with the majority of their client base. But ultimately, as Jeff alluded to earlier, when you start talking about certain funds that have $5 million net worth requirements to get in, there's a lot of clients that can come in, but then it really precludes the vast majority of other clients that we believe alternatives is a very, very needed sleeve within a client's portfolio. But unfortunately, the way the rules work and the way the accreditation standards work, it precluded so many people from getting access to this. So as we were really looking at our portfolio, what we did, we came up with the delivery system that allowed us to convert our private vehicle into a publicly registered vehicle that basically removed the accreditation standards altogether, lowered the minimums down considerably. And for advisors, we thought the benefit to groups would be like, hey, now we can open this up to our entire client mix and allow them access to a nice, steady, risk-adjusted return that otherwise they wouldn't have access to. So it has been, it was quite the process. Dealing with the SEC, we had many moons of 15, 20 person all hands on deck Zoom meetings. I had one of them with I'm not making this up. On the Zoom meeting, the gentleman had a Captain America Marvel shield mounted to his wall, and needless to say, I was texting my lead attorney. I'm like, we're up against Captain America. This is not going to go well.
But you won.
But we won. We finally got through. But then it was even dealing with, from a tax reporting standpoint, making it simple. We used to have K1,
no more K1s, right, for Pender.
No more K1s. We were able to keep our qualified REIT taxation, but get it into a 1099 format. And, I know for many of you, any CPAs in the room, we would still get the 100 phone calls. Hey, can somebody answer the question on this K1? Or, when somebody's asking for it late.
Can you just highlight for the group the benefit of the REIT tax treatment? Real quick.
Oh, the REIT tax treatment. Very high level. Unfortunately, in the private lending world, the taxation's always been a challenge. Generally taxes ordinary income, but getting the qualified REIT taxation designation is a 20% discount on the federal return. So it is a meaningful savings, and now getting that coupled with the K1. saving you all in this room from having to sign a long, boring subdoc, just where it's ticker symbol that your advisors can purchase on your behalf. Really was something that is just ease of use for the clients, ease of use for the borrowers, allowing us to kind of expand the wings within the existing clients that we had, because we've been getting asked about it for years. And we finally figured out a way to actually make this work. And I will say it was not for the faint of heart, though. This was a process
It's a huge project.
We had to wait an additional 90 days because on the Charles Schwab and Fidelity platforms, we were the first registered investment company or interval fund that was taxed as a REIT. So that took us an extra 90 days to get through. So we were an early mover on this, but ultimately still doing the same exact business that we've done before. And that's what's so exciting about it, is being able to provide this and make it easier for all of you in this room, make it easier for the advisors to get access to something that's ultimately getting the same, if not a better return profile with where we stand today. And we had to change the structure around a little bit, so a lot of our fees get thrown down into the fund, so it's a little less expensive for all of you.
And maybe we can use the last couple minutes to talk about where we're at in terms of yield, number of loans in the portfolio, a little bit at a high level of where Pender sits today.
Yeah, absolutely. So the yield has been steadily climbing back up. Right now we're bouncing right between the low nines to the low double digits. We anticipate that to continue to steadily climb as long as we're still able to kind of originate new loans, which we're doing more so, because the way our fee structures are now, every fee that we charge the borrower is down into the fund before it kind of goes back out. So we see a very clear path, and alongside with everything we alluded to earlier with the risk-adjusted yields we're getting from some of these borrowers. We just did a 53% loan-to-value multifamily deal that we got a gross fee that would charge the borrower plus the interest rate, gross fee of 12%. That just flat out did not exist, a few years ago. So we have I see a very clear path to kind of continuing this kind of gradual climb upwards, and candidly, I think we're taking less risk within the portfolio. I do see a way that as we get into next year, candidly, we could probably be in the low double digits moving forward, which will be nice.
And in terms of sectors that you're favoring, we talked a little bit about it, but maybe give the audience a little bit more color on what you're thinking the future portends, maybe.
Yeah, I think for a period of time, again, we're still going to be probably a little overweight in multifamily.
Okay.
Again, just because talking about that liquidity on the secondary market. We're seeing, again, continued industrial. We're finally pricing ourselves into industrial. That was like a unicorn for us for a few years. We just couldn't price our way into it.
It's because industrial is so hot for so long.
So hot.
Right?
The competition for that type of product was unbelievable. Storage has performed very well. I think we'll start dabbling, at some point again in probably the next 12 months. If I feel comfortable with that, we've got a secondary market for maybe some retail assets, but it's going to be really still focused on multifamily. Now, even with that multifamily, right, it's not all created equal. We've historically done a lot of B and C, more affordable type multifamily. You're seeing that market still remain relatively stable. A lot of it's due to the single family housing market. Every first time home buyer with interest rates of what they've done, they are all remaining renters. So that market's been strong. Anyone who bought a project in 2021, they're going to have some challenges, without a doubt. I think one thing that we are concerned with, and we're keeping a very close eye on, is and we're sitting in California, so we're probably all affected by this, but insurance. We've seen insurance premiums skyrocket in some states. We do a lot of business in Texas. California, Texas, Florida seem to be the three big offenders right now.
Well, and that's one thing that's attracted us to Pender originally, right? Because we had a lot of lending strategies, predominantly in California, for years, and because you guys do nationwide loans, you're getting us exposure to loans outside of just California. Yeah.
Well, we really, again, the fundamentals of where we're looking at things, we're really looking kind of, population trends, demographic trends. Texas has been a very strong market. Obviously, South Florida has been a huge market. The Carolinas have been a good market for us. My partner, Zach Murphy, our CIO, when we started Pender, he had worked for a Goldman affiliate fund, and he was going after distressed commercial real estate debt from regional banks, community banks, and whatnot, not in the major money centers, but really more in flyover America. So we still get about 30% of our business from permanent sources of capital saying, hey, I've got this borrower, we can't bank them, or we currently bank them, but we can't do this loan for them. We don't want to lose that business. So that's kind of where our business is really kind of, gone from and driven. And really, back in 17, early 18, when we opened up our Dallas office, it was very strategic. We knew we were going to do a lot of business in that area, but it really, if you took the triangle kind of up from that area, allowed us to really touch a lot of those areas very quickly.
Cool. We're at 20 minutes, folks, so I got to land the plane, but Cory and I will be in the we're going to be stepping out. If you have questions for him, please come up. And again, Cory, thanks for taking the time to share with us the latest on Pender.
Thank you all. Appreciate it.
Thank you.